Okay, so I want to kind of more formally introduce valuation. We started to talk about it yesterday, real brief. I'm not going to go through the whole dramatic explanation I did on the board unless you have questions on it. Maybe better to save that for next week. But I really want to kind of overview some of these processes. But really, just to recap, again, I'm not going to go through the whole overview, but just to recap, the purpose of valuation for us, for investment banking most of the time, is to put a price on a company, whether you are evaluating a stock for purchase, whether the stock's overvalued, undervalued, or whether you're evaluating the company for purchase. And that price is a solid basis of negotiation, right? So that's why you may have in pitch books, if you get to, depending on the stage of the transaction that you're at, you might have not only a purchase price, basically a range in mind, but supporting that range with a lot of processes that investment bankers typically utilize to help value a company, right? So we started with, okay, what's the framework? What is valuation? And there's a lot of ways to identify valuation. So what I want to do today and through the next couple of weeks is to really put you in the mindset of valuation from a banker's perspective. It's a way of thinking, right? It's a convention. So we started with talking about two types of value, book value and market value, and talking about the difference between the two. Right? What is the difference between book value and market value? Well, book value is the value of a business as written up on your books, right? You open up the balance sheet, right? As I was saying, you look up the balance sheet, shareholders' equity. What's the value of the equity of the business? You look up the shareholders' equity. What are the value of the assets? You look up the value of the assets. It's the written up value. Compared to market value, which is the value of the business as determined by the investor, right? It's going along with the theory that the most updated or current value of the business is the last price paid, right? So we kind of gave the example of valuing an automobile, right? If you value an automobile, if you want to sell your used automobile, there's a couple ways you can look at putting a price on that. You can say, well, let me look it up in the blue book, right? And if it's a 2004, whatever, and you look up what the book value of that is, then to you that might be the value of the car. But on the other hand, the market value, you might say, I don't care what the book says. If I put it up on Craigslist and I get 20% higher price, to me that's the value, right? The price paid is the value to me. If someone's going to pay me 20% higher, then that's the value to me. So there's market value and there's book value, right? That's a good way to start looking at it. And we spoke about the ability to use book value and market value as in an application to entities to understand what they're worth. And we spoke about other one other metric called enterprise value, right? And enterprise value is basically market cap plus net debt. There's a bunch of other things too. We talked about why do you subtract cash from net debt in enterprise value, right? So enterprise value is market value or market cap plus short-term debt plus long-term debt minus cash. Why minus cash? And what do we conclude? We concluded why minus cash? Why?
Because it's not part of operating.
It's not, yeah, it's not part the core operating assets of the business. And again, I won't go through the whole elaborate drawing. It's in the book, and I'll have you read it over the weekend. But when taking market cap and adding back the short-term debt plus long-term debt minus cash, you are basically left with the core operating assets of the business. And to an investor, what you're valuing in many cases is not the whole business, but it's the portion of the business that represents the assets that will continue to produce and produce and produce year over year, because that's going to produce future cash that will help you establish your returns. So it's very important to understand. So on one hand, there's book value and market value from a super abstract perspective, right? But then when you get into the details, when you're using tools to value a specific business entity, you can look at the market cap and you can look at enterprise value. Right? And the market cap is the shares times shares outstanding, and enterprise value is taking that market cap and adding back net debt. The implication is you are assessing the value of just the assets of the business, just the operating assets. Okay, so that's what we started to talk about. We said, okay, well, then we went one step further. We said, okay, well, how do we compare and value businesses using market cap and enterprise value. And we said, well, looking at just those values from an abstract perspective isn't really going to help. And we gave the example of two businesses, right? One business that has a market cap of $10 million, and you're comparing that with another business that has a market cap of $12 million. We said, well, which one's better? You can't determine that by just the size and the value. It doesn't tell you if it's undervalued or overvalued. So what we do is we compare the value of the business to what it's producing. And these comparative metrics are multiples. So multiples are a valuable tool to determine relative value, right? Where the numerator is some sort of measure of value, enterprise value, market value, maybe even book value, and the denominator is some sort of operating metric. So to me, if I'm comparing two companies, one that's 10 million and one that's 12 million, it doesn't have as much meaning until I understand what it's producing. And I want to know how much that value is divided by what it's producing to get a more relative determinant. So we said, well, what if both those companies are producing $10 million? They're producing the same thing. So I look at company A, that's 10 million divided by 10 million, right? Enterprise value to net income, 10 million, 10 million, as a multiple of 1. Versus company B, whose market cap was 12 million, but producing the same thing. 12 million divided by 10 is 1.2. So in other words, you're comparing a 1 times multiple business with a 1.2 times multiple business. Suddenly the 1.2 times multiple business is valued higher or can be seen as more expensive for your investment. So very, very brief intro to how multiples are used, and obviously we're going to spend the next weeks on these multiples. But the numerator is some measure of value, and the denominator is some output for us to compare. Well, the value of the business has meaning when I compare it to something of output. Those multiples, 1, 1.2, mean nothing standalone unless you compare them to other multiples. Is one higher than the other? Is one lower than the other? Is one higher than the average? Is one, that's the use of multiples. And it's important to understand that there are two standard categories of multiples: market value multiples and enterprise value multiples. Market value multiples, the numerator is the market cap. Enterprise value multiples, the numerator is the enterprise value. And the reason why there's two is because if I'm using net income as a comparable output metric, my multiple will be market cap to net income, right? Market cap divided by net income. That's just the convention. I just gave you these examples now. I gave you the examples I gave you with the $10 million, $12 million companies, market cap to net income. But if we wanted to use something like EBIT or EBITDA as an underlying metric, we cannot compare that using market cap. We can't have market cap to EBITDA. Why? Because EBITDA is a measure of operations before interest has been paid or before lenders have been paid. That's EBITDA. The market cap is a measure of a business after lenders have been paid. It's based on the stock price. The stock price is the value of a business after lenders have been paid. So if you want to use EBITDA as a comparative metric, then your numerator needs to also be adjusted to be before lenders have been paid, before debt. If the denominator EBIT is before interest, EBIT, the numerator also has to be before interest or really before debt. So you take market cap and you add back net debt, enterprise value. So that's why enterprise value multiples, the numerator is enterprise value, and then the denominator has to be a pre-levered metric, right? Or sorry, a metric before the debt has been paid down, so it's levered. In other words, EBIT, EBITDA, revenue, total assets. So in other words, there are enterprise value to EBIT, enterprise value to EBITDA, enterprise value to sales. Those are enterprise value multiples. Market cap to net income, PE, are market value multiples. Okay? So just get familiar with what they mean. We'll use these throughout the next couple weeks because we're going to go through the 3 major methods of evaluating a corporate entity, and each of these methods end up in having us calculate a whole bunch of these multiples, and we compare them all. And we compare them all in a very specific way to help us determine what the approximate price of the business would be. Okay? Any questions up to this point? So that's the general overview of valuation and metrics. And I want to get into a little bit more detail because There's a lot of investment banking interview questions that center around that. A very popular one now is, how do you value a tech company? And there's no right or wrong answer, but I think there's a right or wrong framework. And they don't want, when you ask questions like that, and we'll approach these questions and the answers to these questions, they're not looking for a number or just a one-word answer. They're looking for, how are you thinking about valuation? And the right way to go about it is to start laying forward and explaining a framework. There's book value, then there's market value, right? Then there's multiples, and then you got to think about how to approach those things. So we'll slowly talk about that once we get a little bit more of a solid understanding of how all this works. Okay? So going from the abstract perspective to the more procedural, mechanical perspective, convention for valuing entities, there are three major methods of doing this. There's the comparable company analysis, the precedent transaction analysis, and the discounted cash flow analysis. We'll talk about each. Each have very unique benefits that will hopefully approach a value of a business, but they each also have very major flaws. And it's important to know the benefits and flaws of each. And so in corporate valuation, we often use all three methods as best we can. Why not just pick one? Because we know each of these methods have such significant flaws that one standalone might not give us a best approximation of value. In some situations, you only have one choice to make. You only have one. We'll talk about that. But it is best to use all three, knowing that each of those three have some major flaws where you say, okay, well, this is a good measure, but this doesn't show this. And so where these three have major flaws, they each have so significantly unique benefits that looking at all three in tandem would help us lay out a more complete picture of what a company should be worth. So we'll do each of these three metrics, and we'll get a range of value. That's why we got to do a range. And we'll see where the ranges overlap. And where the ranges overlap would be a good indicator of value for the business. That's the general approach. I mean, there's some exceptions to it, but that's the general approach. Okay? So let's look at all three. I want to explain them briefly. I want to explain the benefits and drawbacks of each. You should know that. Important investment banking interview question. What are the three major methods? What are the positives and minuses of each? So we're going to go through that. And then we'll start to do them. So today, I'm assuming we'll have time. We'll start to do the DCF. Next week, Monday is your exam. Tuesday, we'll continue with the DCF and talk about the WACC, talk about how the WACC works, give you a lot of good information so you can talk smart about the WACC and be able to calculate it in your internships. And then Wednesday and Thursday, we'll do comps. 2 days of comps. Important to do comps the right way. Okay? So that's all next week. And the week after, we'll have a couple, 2 or 3 days to finish up valuation, and then we'll start practicing for the valuation test. We'll do a bunch of case studies. So I'll spend a couple weeks on this. Okay. The comparable company analysis is a method where you would compare companies that are similar in size, kind of scale, scope, industry, geography, to the one that you're valuing. Right? So the idea of comparable company analysis is, let me look at my company that I'm valuing. I'm going to calculate multiples, all the multiples that you can possibly think of, more or less. I mean, I'll break that down into further detail. And you would find 6 to 8 maybe companies that are similar in industry, geography, scope, scale, and you'd create multiples for each of those companies. We're going to spend next week going through this process. And we compare those multiples to our multiple. So the idea is, if those multiples, the range of those multiples, your competitors' multiples, are much higher, all generally much higher than your company's multiples, maybe your company is undervalued. Why is our company trading much lower than all our competitors? That's the thought process. If our multiple is much higher than the range of competitors, then maybe our company is overvalued. That's the general idea, very general idea, comparable companies. There are benefits to this analysis. There are very unique drawbacks to this analysis. The benefit to this analysis, the most major benefit, I'm on the wrong slide here. The most major benefit is what? Anyone know the most major benefit? Oh, let me not give you the answer. What's the most major benefit? What do you think? Let's think about this. What is a benefit to a comparable company analysis?
It's quick to do.
It may or may not be quick to do. Depends.
It's kind of verified your value.
You do that with all these three. But how is this specific verification process unique in comparison to the other two? What do you think?
It shows what the market is trading.
Which means what? Yes, it shows the market. Yes, it is live, most up to date, perfect, current. It is the only one that's all based on most current data. If you run a comparable company analysis and you have an investment banking meeting and the meeting gets put off for 2 days, this one you can update based on the night before's current stock price. It's super current. So getting back to benefits of market value, I want to give you the example of the car, right? Market value versus book value, for example. Market value is based on what somebody will pay for it today. Current stock prices help you do that. Okay? What's a drawback to comps? I think.
Okay, it's not the right fit in terms of
Yeah, good. I mean, let me just be a little bit more general, but that's the right approach. I mean, it sometimes is very difficult to find competitors. Like, for example, Walmart's going to be a great example. I mean, Walmart, what, $250 billion in market cap, they really don't have competitors. And if you look at maybe like an industry list of companies in that industry, right, big box retailers, next one down is, what, I don't know, Costco, Target, but they're like $200 billion less market cap than them. There's nobody that big that's in this specific industry. So the question is, well, who are their true competitors? It's tough. And you might say, okay, well, from a retail perspective, yeah, Costco, Target, those are their competitors. But then when you're starting to run multiples and you're comparing a $30 billion company with a $200 billion company, those multiples get skewed. So drawback to a comps analysis is sometimes it might be very difficult to find true competitors. And if you do, sometimes it's tough to get the underlying information for them. Think about if you have a private business, doesn't trade. How do you do that then? How do you run multiples? So this is where it becomes tricky. So benefit is super public, super current. Drawback is might be hard to find competitors. Okay?
What happens if you for Walmart?
Yeah.
And next competitor, which is, you say, is not even close there. And if you will multiply all items in the competitor and try to get more close.
Well, because it won't work that way, but it's good thinking, because multiples are relative value. Multiplying the numerator and denominator isn't going to help, right? So if you want to say, okay, well, let's scale up the other companies, I like the way you're thinking about that. It's going to skew the underlying results, I think. I don't think it's going to help. Yeah. Okay. Next analysis, precedent transactions. So basically, when we run comps, and we'll look at comps, and we'll do it, it's just a table of multiples. It's a table of multiples. You probably have seen it. You have your company, and to the right of that, there's just a whole bunch of different multiples that we can use, and we'll learn how to pick them and select them. And then underneath, there's like 5 competitors with just a list of multiples. So precedent transactions is actually also a table of multiples, but the multiples have different meaning. Precedent transactions is comparing the company that you're looking at with other past transactions. It's a historical analysis. And the idea is this. If I want to know how much Walmart is, I'm going to look at other big investment funds, other companies that have bought big box retailers, and I want to see what they paid for that company. Because the price they paid on that entire company is an indication of the value of my company. So if we saw 5 or 6 past transactions of acquisitions of big box retailers, and we saw that companies have paid 5 to 7 times EBITDA for those businesses, our company should be worth 5 to 7 times EBITDA. It's another perspective. Precedent transactions. So it's a table of multiples. But these aren't market multiples. These are purchase multiples. So here comes another type of multiple. We talk about market value, enterprise value, same idea. There are market multiples and there are purchase multiples. Purchase multiples are just like market multiples, same kinds of formulas. Enterprise value to EBITDA, enterprise value to EBIT, same kind of formula. But the difference is the numerator, the value, is not based on the stock price. The value is based on the purchase price of the entity. So when you're doing a purchase multiple, when you're doing a market multiple, market cap to net income, right? Market cap is the market value of the business divided by net income. The purchase multiple version of that is the price paid for the business divided by the net income of the business. And if you're looking at EV to EBITDA, the market value version of EBITDA, as you know, is the market cap plus net debt divided by EBITDA. The purchase multiple version of that is the purchase price paid for the business plus net debt divided by EBITDA. That's the idea. So it's kind of the same kind of formulas where the numerator is value, the denominator is net income or EBITDA, and if you're using EBITDA, you got to add back net debt, but just different perspective. It's not based on the market. It's based on the price paid. So, it's another table of multiples. Benefit to this is it gives you actual price paid, which may include a control premium. So we'll talk about an M&A where sometimes if you're actually looking to buy the business, if you're doing this for an investment banking deal or an acquiring company that you're sponsoring and looking to buy businesses, this will help give you a good indicator as to how much more you have to pay above the current market value to convince the shareholders to give you their shares. We're going to talk about this in M&A. It gives you this premium. It's a benefit. Another benefit is this is based on actual price paid for the entire business. There are also, however, major drawbacks. Major drawbacks is, unlike the comparable companies, this is a historical analysis. So the deals that you're looking for probably happened 6 months ago, probably happened a year ago, because you got to wait long enough before the data comes out. So you might be looking at multiples where now we're in a different market environment. Those multiples might not be relevant anymore. It's a huge issue. Second issue is it might be very difficult to find similar transactions. We had that problem again with Walmart. You know, how often are $200 billion companies being purchased? Well, you know, almost never. So it's very difficult to find similar transactions. And even if you do find similar transactions, you got to kind of Google around and do those. Even if you do find them, it's almost very difficult to find the underlying data supporting those transactions. Your purchase price they'll talk about, but the target company, once it's gone, how are you going to find that target company's financials, especially if it's been absorbed by another company or it's taken private? It's very hard to find underlying data. So a lot of times this analysis, you'll see it's a table of multiples, but a table of multiples is a lot of NA, not available, not available, not available. You might see a lot of those. Sometimes this analysis is just thrown away because it's like this is just not meaningful. But it still needs to be considered. Okay? Finally, we have the discounted cash flow analysis. This is taking a company's future cash flows, and we'll talk about that, taking a company's future cash flows, projecting it out 5 to 7 years, whatever your model has, right? And discounting that to present value. The present value of the future cash flows is the value of the business to me. As an investor, I want to know, if I want to understand what my return is going to be, I want to know how much cash is being produced by the business. Cash from the operations of the business. That's unlevered free cash flow, and we'll talk about the breakdown. Just like enterprise value is a measure of value of the operations, unlevered free cash flow is a measure of cash coming in from the operations of the business. So we project out the first X year cash flows, and then on top of that though, because once we project out the first 5 years of cash flows and get the discounted value, that's the value of the business just for the first 5 years. I want to know the value of the entire business into infinity. So we have to come up with a value for the business from the last projected year out, and that's called the terminal value. And there's a couple ways to get the terminal value. And we'll talk about that. But the idea is we get the current value of the first 5 years back to present value. Then we calculate this terminal value, which is the value of the business from year 5 out. And the sum of those two values is the value of the business to us. The advantages of discounted cash flow analysis is what? What do you think is an advantage of that?
Some base and effect process, and then in some circumstances you just the future.
Yeah, well, why is that an advantage?
Well, at least it may not be 100% correct, but we will have an idea about the future.
Uh-huh.
And that will be the growth rate of the
I mean, all these methods kind of give us an impression on future value, right?
Yeah, but the end of the story, you look at the cash, what you can sorry,
Uh-huh.
the company from your business, which is kind of important to continue the business.
Okay, so just to kind of maybe step back and make it a little bit more general, I mean, it's based on your model. Remember, nothing else is based on your model. Comps is based on the market. I mean, the underlying multiples are based on like historical stuff. And maybe you do like a future multiple that's like next year. We'll talk about that. Precedence is based on past, certainly history. This is based on your model, which gets into a lot of detail. You got COGS, you're being projected, you're matching EPS with the street, maybe not, your cash flow. I mean, this is really based on your model. So it is the most, from that perspective, most technical of the three. It's a benefit. Drawback is your model could be wrong, right? Depending on how you build the model. If you base your model on management projections, it could be super aggressive. If you take a conservative approach, maybe that's less of a drawback. I always like to take a conservative approach. So you want to kind of consider a couple of those things. The other major drawback, I'd forgotten to flip back. The other major drawback is, even though this is super technical based on your model, it's only the first 5 years or 7 years that's based on the model. Everything else is based on this terminal value, which is quite arbitrary. So let's talk about that. Okay? Let's talk about that. So this terminal value, there's two ways to project terminal value. Okay, so first what we would do is, if you want to do a discounted cash flow analysis, if you have a model, great. You want to pull up the components of unlevered free cash flow. We'll talk about that in a second. Okay, and then you discount that to present value using some sort of discount rate method. Most commonly the WACC, the weighted average cost of capital. We'll talk about that on Tuesday. Once you have the first 5 years of cash flows projected, you need to come up with a number to estimate the value of the cash flow from after year 5 to infinity. And there's two methods, two terminal value methods. One is the multiple method. The multiple method is just taking the last projected year's EBIT or EBITDA and multiplying by a multiple. Okay? And we get that value, and we discount that back 5 or 6 years or whatever number of years that to present value, to present. Why is that a measure of value? How can you conceptualize that for me? The idea that taking a multiple of the last year's EBITDA is a value to me of the business from year 5 to infinity.
So you multiply about 1 year, right, into the future.
Mm-hmm.
And then, so you're going to make an assumption at the 1 year time with the perpetuity of the constant free cash flow.
Mm-hmm.
And that's going to be discounted back as you calculate back.
Correct. And what is that, but what is that like, why is that a measure of value?
It's a measure because
It's a tricky question.
Because isn't EBITDA a measure of cash flow?
It is.
Cash flow.
It is. And applying a multiple does what?
It's paying a premium.
It could be, depending on where the multiple comes from. I like the way you're thinking, though. Paying a premium to who?
It's how much you sell the company.
Yeah, that's right. So this terminal value method, applying a multiple, is not really a textbook method. It's more like a banker's method. The banker kind of says, okay, well, in year 5, if I'm going to sell the company to somebody else and they're going to give me a lump sum in cash, that's the value to me. Getting back to the prepaids concept, getting back to the car concept, where we say, well, I can put it up on Craigslist, and if I'm going to get 20% premium, that's what I'm going to get. That's the method. So the idea is, okay, I'm going to build my model for 5 years, and then if I sell the company in year 5, what would I sell it for? How would I sell it? Well, I'll sell it for a multiple of EBITDA. I'll get that one lump sum, and that's the value to me. And then you got to discount that back to present value. But that's the perspective. It's important to understand that perspective. And we'll deal with this actually a lot in a different way in LBOs. In an LBO analysis, at the end of the analysis, we take final year EBITDA times the multiple, because the idea is, well, we've got to figure out how much we're going to get once we sell the business. Right? So we'll look at that. Versus the other method, which is a perpetuity, which is just a mathematical series that slowly converges to 0 or to some number using this method where you take the cash flow and you grow it out times 1 plus G, which is just some basic rate of growth. It's not company growth, it's just the growth rate of cash, 1%, like inflation, 2%, 3%. And then you divide it by the discount rate minus G. Right? That value, that gives you a sequential series adjusting year by year by that growth rate, and then summing up to one large number that represents that should represent the value of the business, basically the value of cash into infinity, and then you discount that back by present value. Yes.
Yeah. So just with the exit multiples, you calculate one multiple forward, right? So you use like say EV and like enterprise value to EBITDA multiple, and for 1 year, and then you multiply the previous cash flow. Is that how?
Yeah. Well, we'll do it. I think it's better. Yeah, we'll do it in the model. I think the question will become easier to explain once we do it, unless you had a question based on that. So usually this perpetuity method is kind of the more textbook method, and oftentimes in a DCF model we do both. We cross-check. We'll do the EBITDA method, we'll do the perpetuity method, and theoretically they should fall in line. They often don't. We'll talk about what happens when they're different. But you'll do both, and you'll have two different values. You have the value, your DCF value based on your perpetuity, DCF value based on your multiple. That's the way you would look at that. Okay? So we'll calculate it more specifically in the model soon. First, though, I want to talk about the cash flow that you project for 5 years, the unlevered free cash flow. Okay? What is unlevered free cash flow? Now, I think you probably have all, especially if you guys studied business finance, have all memorized the formula. What I want to do is make sure you understand where it comes from, because cash flows can be cash flow statements are evolving. You might be in a situation where you have to create your own cash flow statement. We'll go through that analysis towards the end of the program. I want to explain to you what is unlevered free cash flow. It's very simple, so you never have to memorize the formula. As long as you know what it is, how to work with it, that's more important. Unlevered free cash flow. To get there, I first want to explain the actual cash flow, which is a cash flow statement is made up of net income, deferred tax, depreciation, amortization, deferred taxes, other non-cash items, working capital. Okay? I think that's it, right? That's cash from operations. Cash from investing activities is CapEx, and I like to think about the category other for anything else. In investing activities, I really am just more concerned about the CapEx, and then everything else is like investing in assets, selling assets, investing in entities, that's other. And then cash from finance activities, I like to summarize as debts, equity, and distributions, right? Which is raising debt, paying back debt, raising equity, buying back equity, and then paying equity holders, distributions. Okay, that's cash flow. That's cash. What is unlevered free cash flow? What does it mean to be unlevered? What do you mean you don't use it?
It's not factored into the calculation.
Not factored how?
You take out it.
Take it out or keep it in?
Take it out.
Take it out, meaning
Okay.
subtract or add? You got to be careful. It's before debt has been removed. It's a measure of the business before, think about it, before lenders have been paid out. So you take it out of here, meaning you add it back. Or just not include it, depending on your starting point. That's where it's tricky. That's why I don't want to get hung up on add, subtract. Do you understand? It's a measure of the business before the lenders have been paid out. So in enterprise value, we unlever it by adding back the debt. Okay. Free cash flow, what's free? Why is it free? Yeah, but free in this case. What's free cash flow in this case? Do you know what free? Available to who? To the shareholders, to everybody. It is free cash from unlevered free cash flow should represent cash flow before lenders have been paid, cash flow available to equity holders before equity holders have been paid, and cash flow that's generated without any one-off items, true to everyday operations. Okay, so from that perspective, free to equity holders, free to lenders. So basically the whole financing activity section is gone. Anything related to financing is gone. Free cash flow, eliminate everything related to financing activities. Strike that. Okay. And in the investing activities, I only want to know the cash that's required for everyday maintenance and upkeep of my operating assets. Forget any other acquisitions, divestitures, anything that might be one-off, investments, other is gone. And this is where, I think Alex, you asked the question where in the program, the difference between maintenance CapEx and, say again?
I thought growth CapEx.
Growth CapEx, yeah. I don't know why I blanked on that. Usually the companies don't break them out, but if they do, ideally, you just want maintenance CapEx, not growth CapEx, because growth CapEx is superfluous. It's above and beyond everyday operations. And a lot of times you just want what you need to maintain your cash now. So if you have the ability to just separate out maintenance CapEx, that's the CapEx we're talking about here. But usually you don't get into that detail. But the idea is you want cash true to everyday operations and before any equity holders and lenders have been paid or available to equity holders and lenders. So that's striking out financing activities and striking out all investing activities with the exception of CapEx, because even though CapEx is investing, it's seen as operating in the sense that you need that to maintain your operations, to maintain your operating assets. Okay? So, if you wipe out all the items you don't need, you're left with net income, you're left with depreciation, amortization, deferred tax, other non-cash items, working capital. But this is not completely unlevered. Why not? Yes. You have interest in net income. So you need to add back interest, and interest is tax deductible. So you want to add back after-tax interest. That's the formula for unlevered free cash flow. After-tax interest.
Why after tax? Sorry.
Because if you added back interest, you add back the taxes that go with it, the tax deductions that go with it. Now, that's unlevered free cash flow when you break down the cash flow statement. But oftentimes, we don't build to unlevered free cash flow with net income. There's a couple reasons for that. One of the main reasons is if you were just to build out unlevered free cash flow, for example, and you don't have a full model, and you just kind of, and we'll do a lot of this, we'll do a lot of practice like the case study is, you just want to project from scratch. Why build all the way down to net income when you have to back out a lot of those items anyway? You have to back out depreciation, you have to back out some working capital, you have to back out after-tax interest. It almost seems redundant. So better to start with a number that's higher up on the income statement, EBITDA, or say EBIT. Okay? And if you started with EBIT, because it's much easier just to project EBIT than to project all the way down income statement, then you got to build a depreciation schedule, then you got to do taxes, and all. Well, a lot of stuff's getting add back anyway. If you were to start with EBIT, and you want to get the same exact number that you get here, what adjustments would you make?
You add back depreciation.
You add back depreciation still, yep. What else? Deferred taxes also. Still add back other. What else? Yeah, same thing working capital. What about interest? Okay, but what else do you do? There's something that this has that this doesn't? Tax. So you need to subtract tax, and you have to calculate this. And the way you calculate tax, very important, it's not the tax. Don't pull the tax number from the income statement. It's EBIT times tax percentage. It's EBIT times the tax rate. Very important that it's EBIT times tax rate, because the tax number on your income statement has interest buried in there. You don't want that. And this is the formula that you probably know for unlevered free cash flow. It gives you the same number as this, but just so you know where it comes from. EBIT, add back D&A, add back deferred taxes, other non-cash items if they exist. Make your working capital adjustments. Remove CapEx. Sorry, I forgot that from both sides. And make an adjustment for taxes. Okay, that's unlevered.
With the taxes, are we using a marginal tax rate then, or are we just using historical?
I would definitely use the same exact tax rate from the income statement. Use a tax rate from the income statement, but yeah, don't make up the tax rate so it falls in line. But definitely don't use the tax number. So we project out that cash flow, discount it, apply a terminal value, and that's how we get the discounted cash flow analysis. Any questions on that? Okay, let's pull up the model and let's do it. So let's pull up the model. And if you notice, now that we're done with the debt schedule, to the right there's this valuation tab. This is just an indicator that valuation comes next. DCF comps. Here's a DCF tab. Let's pull out discounted cash flow. I'm going to do 5-year unlevered free cash flow projections, and I'm going to apply terminal value to discount everything back and discount everything back. Okay. So the first thing I have is EBIT. So I'm just going to pull in, it's very simple, the relevant line items from the model that we built. Okay? So EBIT, I'm going to pull in from the income statement. Okay? And then we continue depreciation. You know, aside from EBIT, I like to just pull everything else from the cash flow statement because we're basically replicating cash flows. And the real important reason, I guess I should have stressed this, of thinking about the unlevered free cash flow this way is because I get a lot of questions and confusions about, are you adding or subtracting things? And it's very simple. Just do what the cash flow statement does. If the cash flow statement is removing it, then remove it. If the cash flow statement is adding, then add it. And actually somebody from like a private equity firm wrote me like a scathing email once because I have plus changes in working capital. I said, no, it's minus. It's minus in all the textbooks. But this is my point. My point is if the cash flow statement is adding working capital, add the working capital. So a lot of people, I think, wrongly misinterpret minus working capital as, okay, I'm going to go to the cash flow statement and working capital shows positive and flip the signs. So I don't agree with the textbook. I think it's misleading. If nobody breaks it down and explains it, no textbook explains it. If you do what the cash flow statement does, you'll avoid any confusion ever about should I add or should I subtract, because you're basically simplifying the cash flow statement. Just think of it that way. And there's no other, the reason why they say minus changes in working capital is because what they mean is, well, if you go to the balance sheet and you're taking this year and minus last year, as you know, and assets going up, it's minus those changes. To me, that's overcomplicating it. Just go to the cash flow statement. That's where it is. It makes no sense to me for them to all of a sudden say, okay, this is a cash flow line, this is cash flow line, all of a sudden go to the balance sheet for working capital and flip the sign. So, real simple, if you can see it this way, you're just replicating the cash statement line items. So that's why I like to, although D&A can come from the income statement, I like to put you in the mindset of we're really just, it's a simplification of the cash flow statement, okay? The deferred taxes. Deferred taxes, okay? Other, we're going to talk about this and get tricky. We'll talk about that after the break. Or maybe, I didn't realize it was so early. Maybe we'll talk about it soon. Changes in working capital. Again, do not flip the signs. If the cash flow statement here is adding it, you have to add it. Otherwise, you're double counting a negative, right? Hopefully you understand that. CapEx. Do what the cash flow statement does. It's removing CapEx. You want to remove CapEx. Okay? Taxes, very important. EBIT times tax rate. Very important to not pull the taxes from the income statement because taxes in the income statement has interest buried in there. So I'm going to go up to the EBIT, and I'm going to, it's going to be minus EBIT times income statement tax rate. In that respective year. Okay, so I'll give you guys some time to get to this point, and once everybody has this, up to the right, we'll talk about other. Correct. Okay, this can get a little tricky. So, based on what I drew on the board, okay, we're basically wanting to capture all cash from operations, right? We basically want to capture this number, okay? More or less, basically. I say basically because this number is driven from net income, and we're pulling from EBITDA, right? But everything in here we want to capture. And it's natural that the cash from operations is typically made up of deferred taxes, depreciation, amortization, and working capital. The one variable in there is other non-cash items. And I wrote that in these slides for good reason, okay? Because you're going to have to face the decision of whether these other non-cash items should be included in your analysis or not. And it might not be as straightforward as you might think, okay? I'm going to give you an example. Let's say, I'll do this online so it can be recorded because it's tricky. Let's say we have an income statement. Perfect. We have an income statement of a company whose EBIT is 60. Fine, let's continue with this. No, I'm going to do this a little bit different. Okay. Let's say we have revenue, okay, of 1,000. Okay. We have COGS, okay, of 200. Okay. We have OPEX of 100. Okay. I have one-time salary adjustment, whatever. Okay. 50. Okay. What's my EBIT? 750, right? 650. Right. Okay. Now let's continue down. So now I have taxes of, I'm just to make the math simple, otherwise it's going to drive me crazy, 100. Forget the percentage. Is that going to trick us later? Let me just multiply out 40%. Okay. We have taxes of 40%. You got it? What is that? 26. 260, right? 260, and then 650 minus 260 is 390. Okay, 390. Okay. We then have a non-recurring event of 90. And my net income now becomes 300. Okay? You okay with this? You okay with that? Everybody okay with that? Okay. Now, I have my cash flow statement. Cash flow statement starts with net income of the 300, right? I want to build my cash flow statement, okay? DNA is 0. Let's say what I do is I'm going to add back that non-occurring charge, okay, of 90 because it's non-cash, okay? I'm also going to add back this one-time salary adjustment because I didn't pay it yet. I owe it. I didn't pay it. So what's my cash? 430, 440, okay? Let me be more accurate. I got to add back my COGS too, right? As inventory. So that's 640. Okay? You okay?
When you take the non-closed expense like this, did you just for yourself or any sample?
No, just an assumption. Okay, now, we want to build now unlevered free cash flow, okay? Okay. What do I do? How do I build unlevered free cash flow? Start the EBIT. 650. What else? Add back depreciation. What else? And there's none in there. Let's assume not.
Other non-closed?
Okay, let's do working capital first. What was what? Okay. Now we're left with other. Okay, this is what I want to illustrate. These two other line items. Do we add them back or not? Yeah. Do we add them back or not? What do you think? That's what I want to illustrate.
Other non-closed is coming.
That's the question.
Well, logic was that we haven't already paid yet, that's why we're adding it, so since that's still cash and available to us, we should add it.
That's one step towards the direction, Alex.
I disagree.
Alex
This is a
disagrees.
one-time expenses,
Mm-hmm.
which doesn't really affect the operations of the company going moving forward. So
Okay.
that's why I argue that we shouldn't add it.
But that by them adding it back, they are undoing it. They are effectively excluding it. Right?
Oh, right, okay.
Mm-hmm. So you change your mind?
Yeah, you should add it.
Then you should add it back to undo it.
Yep.
Okay? Anybody else? You gotta take it one step further. Okay? You don't add them both back. One you do, one you don't. Yeah. Yeah, and the reason why is, so non-occurring of 90. So I'm glad you went through this thought process because you realize now that adding this back basically undoes the impact. Right? It undoes the impact. We had net income of 390, everything was fine, and then this one-time hit came in that brought the 390 down to 90. But the cash flow said, well, that wasn't non-cash, so I'm going to add it back to remove the effects of it. Right? That's what the cash flow says. Okay. But because our unlevered free cash flow started with EBIT, EBIT did not have that 90 removed from it anyway. So if we were to add 90, we would be double counting. We would be double adding it back. You only want to make adjustments for line items that you've proven are above the EBIT line. And that's hard to do. See what I'm saying?
So add the one-time salary, but not.
Yeah, so not that. Now the salary adjustment, the cash will add it back because it said, okay, this is a one-time adjustment. It brought my EBIT down to 650. It should have been 700, so I'm going to add that back. That you still do because we're starting with EBIT. Those are the adjustments that you make. You do not make this non-occurring event adjustment because it's removed from net income underneath where it wasn't removed from EBIT. I don't know the best way I can explain it.
Can you say again about the salary?
Salary you add back because it was removed from EBIT. Yeah, see, it's down here. It's brought our EBIT down by 650. So if the cash flow is adding it back. So we still do what the cash flow statement does, but you just have to know in your mind you have a different starting point. So there might be impacts based on that different starting point. Those impacts really only apply to other items. It doesn't apply to depreciation. It doesn't apply to deferred tax. Everything that we have here. Okay? It doesn't apply to the taxes. Okay? You have to be careful of that. So when we go to the cash flow statement, we want to look at all the adjustments that we've made. And it's simple in this case, okay? So depreciation, deferred taxes, working capital, very simple. We're left with two items. We're left with other and discontinued operations. Question is, which of these, if any, do we add back? Let's start with discontinued operations. Do we add that back?
No, because it's below the EBIT line.
Correct. No. They're adding it back, basically undoing the impacts of it. But this was a line item that was removed way, way under net income. EBIT's never touched it. Right? EBIT never had it removed anyway, so we don't add it back. What about other operating items? How would you think about that? Why? Do you know it's before EBIT? How would you know? Because it's called operating expenses? I guess you can make that guess. You have to think about it though. You know, you want to think about, this is an add back, and you want to think about what expense is this, is it adding back? It's some sort of operating activity. Yeah, I could make the, I could make the assumption that it's got to be, since it's operating above EBIT. The only exception to that is if there was some other income, it could have been a portion of that, but there is no other income here. There's nowhere else that I think it could go. It's not interest, that's not operating. It's not income tax expense, because that would be deferred taxes. It's not discontinued operations, because they already made an adjustment for it. There's really no other place it can go except above the EBIT line. But you have to have that thought process and mindset in place. Okay? So because I agree with you, I assume that this other operating activity must be above EBIT, I would add that back. I would do what the cash flow statement does. So I'd go into the my DCF, and for other, I would include the other operating activities, but not the discontinued operations. And it's just important to know why. Okay, it's kind of advanced, but and that's our cash flow. Okay? Any questions on that? I know that's tricky, but it's on the recordings.
So just to be clear, anything below the EBIT line, or below EBIT, you don't add back anything that's above, that's to say add back except depreciation or that other stuff, right?
Any other line item.
Any other line item above
Right.
EBIT, you should consider whether you should add it back or not.
Right.
Yeah.
Basically, anything above EBIT you got to consider, right? Anything, but
No, but not in the formula.
given the nature, well, because everything else in the form of DNA, deferred taxes, is always below EBIT.
Oh, yeah.
Yeah. Okay. Now we discount these cash flows back, and we wanted to discount them at some rate. We pretty much always use the weighted average cost of capital. I'm not going to get into that today. That's going to be a next week discussion. So for now, let's just force the discount rate, which goes in this box, to be like 10%. We'll talk about that. We'll update that later. Okay? 10%. And I want you to know the formula for discounting. So first of all, what's the period? Well, we're going to discount the first one by 1 year, second by 2 years, 3, 4, 5. Okay? That should be blue. There is, just so you know, a mid-year, this is end of year convention. There's a mid-year convention where it's not 1, 2, 3, 4, 5, but it's 0.5, 1.5, 2.5, 3.5, 4.5. That's the mid-year convention. The idea is basically, well, the end of year convention, 1, 2, 3, 4, 5, is basically discounting this 14.9 billion by a whole year, basically implying that you're getting all that cash in one lump sum. So the mid-year convention, discounting it by just a half of year, kind of averages it. That's the convention. Some things I think just get silly and over-engineered. I mean, we're talking about a range of value that's $10 to $20 billion. I don't think it's going to make a difference. But just, some firms and banks prefer one convention over the next. Just know the differences. Mid-year convention just kind of says, okay, well, I'm not going to discount this $50 billion by a full year. I'm going to discount it by half a year, implying that the cash is going to trickle in and things like that. Got it? Sure? Okay, so to discount things, we need to take that 14.9 billion divided by, in parentheses, 1 plus the discount rate. I'm going to anchor the value to the discount rate so I can copy to the right, to the power of the number of years. You have to memorize the discount formula. I mentioned to you in the morning, the next exam, not this is the evaluation exam. I want this to be prep for interviews, and you got to know the formulas for your interviews. You got to know the formulas. So it's going to be a lot of the Q&A portion. Is going to be just a lot of formulas. Do you know the formulas? So it's the cash flow divided by 1 plus the discount rate to the power of the number of years. Copy to the right. And the sum of that, let's make sure you're getting that, is the value of the business. Okay. And then here, this total net present value, they're asking for just the sum of everything. Right, this is the value of the business for the first 5 years, $60 billion is what we assume. I mean, that's going to change when we change the discount rate, but this is the idea. Okay? Any questions on that?
So yeah, just going back to the period, but you mentioned that there's like a mid-year convention.
Yeah.
Is there like quarterly conventions as well and with different assumptions? Like, so my assumption is that when you're assuming that cash flows occur at half-year increments as opposed to 1-year increments, right? And that makes
not increments, no, because if you're saying, well, you want to do increments, then build a monthly model. You know what I'm saying?
Right.
This is just basically saying, assume that this cash is discounted by half a year. It's not an incremental thing. It's, in other words, don't discount by a full year, because discounting by a full 365 days implies that it comes in on the very last day.
Yeah.
So discounting by a half a year basically is an average of sorts, you know.
Okay.
So going into quarter year or 3/4 year wouldn't apply there.
So then, does that mean you start at 0.5, you have to increase it by 0.5?
Yeah, so it's 0.5, 1.5, 2.5, 3.5, 4.5.
Okay.
Yep. That's the way to do it. So really the right way to do this is, if I hard code 1, I just didn't do this in the book, so H16 is going to be the year before plus 1, right? So that way there's the full year convention, and if 1 half year, I make it 0.5. And then it's, right, it's always up by 1. Yep. Okay? Okay. Good time for a break. We're going to come back and apply this to the terminal value methods, and then let's see what we got from there. Okay? All right, so once we have the present value of the cash flows, it's now time for us to figure out what the value of the cash flows would be from after year 5. So there's 2 ways to look at it. Terminal value. We can look at it using the EBITDA method, or we can look at it using the perpetuity method. Okay, so let's look at both. I'm going to start with the perpetuity because it's just a straightforward formula. Inputs are the WACC, or discount rate WACC, and growth rate. Some growth rate representing rate of inflation. Typically it's been 3 to 4%, but more recently people have been using 1 to 1.5%. So let's start with a really small percentage, 1%. And when we step back, I can show you how to cross-check and compare and all this stuff, okay? And the perpetuity formula, and something else you have to memorize, is equal to the final year cash flow, not discounted. Don't make the mistake of taking the discounted one. A lot of people do that in the case study. Take the pre-discount, because we're going to discount everything. Pre-discounted cash flow, final year, times 1 plus the growth rate.
Divide that by the weighted average carrying cost.
Bless you. Divided by, in parentheses, WACC minus the growth rate. Okay. So 183 billion is the implied value of the business after year 5. Okay? See the formula again? It's the final year cash flow, non-discounted, times 1 plus G divided by R minus G. Okay? So, actually, sorry, well, just a formatting thing that should have been done down here. I don't know how much you care to move it. That formula was actually supposed to be here, and this was just to pull in just the cash flow that we're using. Yeah, I don't, it's just, it's a formatting thing. Instead of doing it all in one shot, what's the cash flow? If you want to go through the work of changing it, I don't know how much of a deal it makes. Okay. Just one extra step in there. And then we discount that back to present value by taking terminal value divided by, in parentheses, 1 plus the growth rate to the power of the number of years. And the convention that you use has to fall in line, right? If you're using mid-year, you got to use mid-year here. If you're using end of year, you got to use end of year.
I'm sorry. Can you go back to the terminal value?
Yes. You guys okay? Okay. Do the same thing for the EBITDA method. It asks for the final year EBITDA, so let's pull that in. That's EBIT plus D&A. And we apply a multiple. So the question is, where does the multiple come from? So this is where you can look at comps. You can look at your other methods. We don't have our other methods, and we'll learn in the LBO class, or part of the program, that conservatively you can use the current multiple of the business. So we'll learn about this in LBOs when we do entry versus exit, right? We buy the company and then we say, okay, in 5 years when we sell the company, what's our return? And then we often do, well, what are we going to sell the company for? As a conservative measure, we usually say we're going to sell the company for the same multiple that we bought it for. You might think, well, if it's the same multiple, how are you making money? Well, we're going to hope that the EBITDA would have grown over 5 years. So conservatively, if you sell the company for the same multiple that you bought it for, the idea that the fact that the EBITDA is growing would show a higher valued return. So for now, let's use that same approach. Let's calculate the current multiple for the company and use that. Okay, so to calculate the multiple, we need to get EBITDA, we need to get net debt. So what I'm going to do is, instead of putting that all into this formula, because that's going to be a big formula, calculate enterprise value, to the right here, we're going to need, we'll talk about next week, we're going to need for the weighted average cost of capital, we're going to need we're going to need debt, we're going to need equity, we're going to need market cap, we're going to need all these things. So I want to lay out market cap here, debt, net debt. So we have enterprise value here. I want to calculate enterprise value in this table so that this formula doesn't look so complicated. Okay, so the first thing I want to do is I want to pull in the total balance of debt. Total debt, not net debt. Okay, so I'm going to go in from the balance sheet, and I'm going to get the 2012 total debt. Okay, so I'm going to get, that's going to be long-term debt, long-term debt obligations, long-term debt due within a year. It should be 5 things, right? Capital lease obligations due within a year, and there should be a short-term debt. Okay, so that should be 53427. That's total debt. That's total debt. Okay. I can show you that formula again. 5 pieces of debts, right? The ending balances of all, each and all. Okay, you have this? Just pull in the 5 debts, okay? So that's total debt. And I want to calculate equity value, because equity value plus actually the net debt is going to be enterprise value. So let me just pull in the stock price. If you remember, we have that on the income statement. 73.82. Stock price. Shares outstanding, I believe, oh, we definitely have it on the income statement. We want the diluted, okay? Most up-to-date diluted shares outstanding. Always valuation, comps, we want to do diluted shares, okay? So the most up-to-date diluted shares one, was that here? No, that was, which one do we pull in from? That's basically the 3366. That's this number, okay? Diluted shares outstanding, okay? And we're going to multiply to get, we want the most up-to-date market cap. Okay? And then I want to add, I didn't do this in the book, and I realized later when doing this with you guys that it's just, this formula on the side is way too convoluted. So I want enterprise value instead of part of that formula. I'm going to just separate it out. It's not going to change the number. It's just going to be more clear. Which is equity value plus net debt. Okay? So enterprise value is going to be equity value plus total debt plus non-controlling interests minus cash. Okay? Plus non-controlling interests. And when I say non-controlling, I mean this total balance plus the redeemable balance minus cash. Okay, that's their total enterprise value. Why plus non-controlling interests? You know? I didn't get into the full, complete formula for enterprise value. It's in the book. It's in the reading. But full enterprise value, do I have it laid out here? Am I thinking of, oh yeah, is market cap plus total debt minus cash plus preferred securities plus non-controlling interests plus any other non-operating liabilities. We will get into more of that and actually have a great investment banking interview question we'll have time to go through today that'll best illustrate why that is. I actually have a pretty good one. It's in the book. It should be coming out actually this week, right?
Yeah. Next week. 30.
Get out. Okay. It has all these interview questions laid out. But we'll go through them in class too. Okay, are you getting these numbers? Do you want to look at formulas? How you doing? You want to see this formula? I just pulled it from the income statement, just to be consistent. Yep. D53.
So we have to pull that out from the market value of whatever it's trading at the moment.
Yeah, and we had done that. That's what that is. Yeah, we did that when diluting shares. Okay? Good. So we're going to calculate the multiple, the implied multiple, which is that enterprise value divided by EBITDA, which I'll pull from the income statement. I was going to say pull it from the unlevered cash flow, but we can't because that's a projected. So we're going to do the last reported is the perspective I'm going to give, which is 8.7 times. Okay? And we're going to cross-check out the comps. Later when we have the comps, we have a range. We can adjust it, just ballpark. And we're going to use that to calculate an implied terminal value, which is the EBITDA times the multiple. So that's $365 billion. That will have to discount as well, just like perpetuity. Okay? So to discount that, we're going to take the terminal value divided by, in parentheses, 1 plus discount rate to the power of number of years, 5, 226. These are way different. They're supposed to be in line, but we have a made-up whack. The whack is wrong. We're going to fix the whack next week. One important thing to notice is for the EBITDA method, we discounted by full years. Even if the cash flow was set to mid-year convention, this would still always be end-of-year convention. Terminal value EBITDA method is always end-of-year convention. Why? What? Say again?
You have to use EBITDA from the last 12 months. You can take an average.
Well, you kind of, no, you can, and you kind of effectively do because EBITDA is a component of unlevered free cash flow. Why else? Anybody? What do you think? Set myself a note to be reading. It's based on the perspective, right? The perspective of the EBITDA method is what we discussed before. It is a sale. It is a one-time sale, right? The perspective of the EBITDA method, unlike perpetuity is continuing cash flows. So you do, if you do mid-year, you do mid-year. For EBITDA method, no matter what you did for cash flows, you're assuming you're going to sell the business in one lump sum at the end of the period, always. So you're getting that cash in one lump sum. You're not getting cash trickled in.
Yeah, but this is how they sell like they sell whatever. Isn't that
Don't confuse discounting by half a year meaning that they're going to sell the business in June. Discounting half a year is averaging the cash flows coming in, right? You're just discounting it less.
Well, I'm saying, but when someone sells a business, it's not exactly I sell at the end of the year, at that specific, right? They sell it any time in the period, right?
That's true.
So then how do you factor that?
You don't. Oh, that's what